always an honour to be here. I think we've told a relatively compelling story over the last 6 years, and we've certainly had 6 years of success. Here we go, we've got the presentation up. And so, I'm the finance director of the company. I've been the one that's been coming here every year. What I'll do is I'll explain for those who haven't heard the story before what our business proposition is and strategy. I'll touch briefly after that on recent half-year results that we released for 31 December that came out in February. And the most important part of the speech will be the second part of the speech, where I'll talk about why it's a good investment today and why you should be buying shares next week. And that is all to do with how we're growing and what we're delivering in the coming months that will drive revenue and earnings. So that'll be the most important part of the speech. So Avation is an aircraft lessor. That is, we buy commercial passenger aircraft and we rent them to airlines. That's all we do. And the concept's very similar to buying a flat to let. You know, you go and find the best flat you can. In our case, we go and find the best, most popular aircraft that we can. And then we put a tenant in them, which is an airline. Airlines that would be household names to you that you would have flown with. So you may have flown on one of our planes, actually. And we typically use, bank debt to help us buy those planes. So just as you would do with a flat or an apartment. Where our business is different from owning a flat to let is in two key features. The first is an aircraft will generate about 12% yield per year on the asset. So a $100 million plane generates about $12 million a year rent. That would be the equivalent of your $1 million flat generating £120,000 a year rent. Now, if you could find a flat that did that, you'd buy that flat. And the second thing is that airlines are happy to sign 10 and 12-year leases for the aircraft at that fixed rate of rent. Now, simple mathematics will tell you that if you have a 10-year lease at 12% yield, you get back 120% what that aircraft costs. So it pays itself off in the first lease. Sound interesting? Yeah, sounds very interesting, doesn't it? That's all we do. We've been doing this for 13 years. The company's been continuously profitable. We do pay a dividend, but the reason to buy this stock is that we have a cumulative annual growth rate in the fleet, so that's the planes that we own, of 30% a year, which drives, correlates to revenue growth per year, correlates to earnings growth per year, and is correlated 100% to share price. So the name of the speech that I put on when they asked me, what do you want to call your speech? I said, you double a fleet, you double your share price. How do I know that that's true? Well, I actually look back to the first time I came to Master Investor 6 years ago. At that point in time, since that point in time, we've quadrupled the fleet and quadrupled the share price. And our goal right now, I'll tell you right now, is that we are planning to double the fleet from where we are today. And that we think will turn into share price growth. So just where we are right now, we're based in Singapore because we pay 8% corporate tax in Singapore, but we're listed on the standard listing on the main board of the London Stock Exchange. We've been going for 13 years. We supply aircraft to airlines globally now. We started off very small, supplying aircraft to one airline in Western Australia. We evolved the company to supplying to a national carrier, which was Virgin Australia. And then over the last 5 or 6 years, we've really gone global. And we now have 15 customers in our suite of customers, which is diversification, lowers risk, of course. And we expect in a year's time probably to be over 20 customers. We've got 43 aircraft, and we announced that we delivered 3 into the fleet last week. We've got the biggest stuff, the wide bodies. Most of our fleet are narrow bodies. And we've got 22 turboprops, which represent about a third of our fleet. Those of you who know the company know that 5 or 6 years ago, we were very reliant on the turboprop, the ATR turboprop. What we've done since then is evolve into bigger aircraft that the bigger airlines like. So we've got more arrows in the quiver, and we can supply more things to more airlines. And that's why the growth opportunity is actually accelerating. We've got a very young fleet, and they've got a long time to run on their leases. So the average age of the 43 planes is 3.6 years, and they've got 7.5 years to run at their current rental, and we're collecting $11 million a month right now. And most importantly, the reason why you're all here is that we have got immediate short-term growth. We're talking the next 8 weeks. We are going to deliver probably at least 6 aircraft into the fleet. That'll grow the fleet base, it'll grow the revenue, and you'll see that revenue in the 2020 results, because our year end is 30 June. So if you deliver a plane in May and June, it doesn't contribute much rent and revenue and earnings to that year. So all these planes we're delivering right now are going to provide a huge growth in revenue in the financial year into 30 June 2020. That's why you buy the shares today. That growth will be translated to revenue and earnings growth in 2020, which will translate it into share price growth. So currently we have 15 aircraft, but as I said, we are adding to that as we speak, and we'll add customers in the next few weeks. Those planes operate in 12 different countries all throughout the world. We've been on the London Stock Exchange for 9 years, and we also issue unsecured debt. If you're interested in buying bonds, our bonds yield 6.5% coupon. We've got a credit rating which was upgraded a couple of times during the year from Fitch to BB- and S&P, which is B+. The founder of the company is Jeff Chatfield, who's also a major shareholder. Board and management own 22% of this company. It's my largest personal investment. So we are perfectly aligned with your interests. We make money when the share price goes up because we hold the shares ourselves. We have over 22 people, 23, 24 people working in the company today. Our total admin cost, which includes all our rent, travel, marketing, regulatory costs, was about $10 million. So nobody earns $1 million salaries. But we're shareholders and we're trying to make the share price go up. So just another way to look at the snapshot, 43 aircraft in 15 customers in 12 countries. There's the split between our investment in the big stuff, the narrow bodies and the turboprops. And as I said, these planes will generate $11 million a month rent for 7.5 years, which that's this number here. So we have almost $900 million of revenue that's going to be that's contracted with the existing fleet, and that number grows every time we add a plane, and every month it comes down by the $11 million of the rent that we do. But if you look at our balance sheet, and I've got copies at our stand of our balance sheet as of 31 December, you'll see that number, the revenue that we've yet to collect over the 7.5 years, is equivalent to what our net debt is. So the rent pays off the debt. And that's the same thing that I explained to you. 10 years, 12-year rent, planes pay it works for the whole fleet. So we've got over 1.25 billion in total assets. $1 billion of that, over 1.05, or today it's more like 1.1, is aircraft. The rest is just cash. And we use that cash to buy more aircraft. And as I said, the most important reason to look at this stock today, and the reason why you came here today is obviously you want to invest and make money, is that those 6 planes we're delivering in the next few months will drive revenue growth, especially in 2020. So, why do I have confidence in that we can do that? Because these are 3-year snapshots. 12, 15, financial year 18, then this is the half year. This shows us growing the fleet significantly. The better chart is this one, total assets. You see every 3 years, doubled. Translates as a revenue. And that's what's happened to the share price. The share price has followed this as well. So that's proof in the pudding. This is why I sit here or stand here with conviction and say our goal right now remains the same as it was here and here, and that's to double the fleet from where it is today. So our 31 December results were a record for us. We had 40% year-on-year revenue growth, and that's because a year before December 2017, we had record fleet growth. Exactly what's happening right now with the 3 planes we delivered last week and the 6 we're delivering in the coming months. So you'll see this happen again. This cycle will happen again when we for 30 June 2020, which is 14 months away. That's how long, the minimum you should be thinking about holding this stock. Profits were up 60%. EPS, profit after tax, up 100, double. We paid, first time we ever paid a dividend in respect to the first half of the year. The years we've been paying a dividend in respect to the full financial year, but we're going to pay a second dividend in relation to the results that we generate to 30 June. And we brought down our cost of debt. Obviously, I just told you what we generate in revenue, so we generate 12% on the assets, and we pay 5% cost of debt. So like a bank, our net interest margin is the difference between those two. No bank earns 7% net interest margin. Banks make 1 or 2%. This is a very profitable company. So this is what we've done so far. As I said, 30 June year end, so we're 9 months through the year. We've delivered 6 aircraft and fleet. We've got an order for 4 more. We're just about to buy a Boeing 737-800. That's the old version. It's not the MAX. We don't have any exposure to MAXs. I know that 5 people want to ask me that question, but we don't have any exposure to MAXs. And we do are long-term believers in Boeing, by the way. I'm quite happy to state that now. They will fix that problem. But we don't have any exposure. We don't really want any exposure in the short term while they are fixing that problem. In fact, we bought that plane before the problems. We think, even though we are finalising that contract as we speak, we think the value of that plane's gone up. The bad news for the MAX is actually good news for the old version. We've got some more opportunity to buy ATRs in the long-term future. We increased the number of customers. We repaid all our expensive junior debt and some of our expensive senior debt because we're using more unsecured now that our credit rating's improved, and using more unsecured means that we have 9 unencumbered planes on the balance sheet as of 31 December. Having unencumbered planes on the balance sheet means you can remortgage them if you need cash to buy more planes. So we've got the best financial flexibility that we've ever had in the history of the company, which is why we know we can finance these 6 planes that are coming in the short term. Credit ratings upgrades and success in getting access to the market. The fundamental reason why this company is good is that the global fleet of aircraft doubles every 15 years. It's as simple as that. Which means that the doubling of the fleet means demand by airlines for aircraft. And you know that over 60% of Airbus's products last year were paid for by lessors like us. Airlines don't own their planes. Last year they only bought 40% of the total planes that were manufactured. Today, it's about 1 in 2 planes are owned by lessors. But that's actually growing because lessors are paying for more than half the stuff that's coming off the production line today. And this is what our current fleet looks like as of this week. We delivered our 43rd plane, I think, on Monday. So we've got 22 turboprops. We've got over a dozen narrow bodies, and we've got a couple of wide bodies as well. We've evolved the company to, we really didn't have much exposure to these aircraft until 5 years ago. We didn't really have exposure to these till a year ago. So we've evolved the company to supply more types of planes to service more of the airline industry. So we can do more things for our customers than we've ever done before. That's why the growth opportunity remains intact. And whether you're an existing shareholder or you don't own shares, the fundamental question you should be asking yourself is, if this is a growth company, is the growth opportunity still intact? And the second question is it more or less risky than it was before? Hopefully I've just explained why the growth opportunity is still intact. And of course we've got more customers than ever, and customers supply repeat business, so that's another reason why the growth opportunity is intact. Now I'll explain about why I think it's lower risk than it's ever been before. The fleet's still very young, and that's because our fundamental philosophy on aircraft is to buy young or brand new stuff and you put it on long-term leases. And that's how you keep those metrics strong, by selling the old stuff that's almost run out of leases and buying new stuff. So these are our customers. There are names that you know, household names. Some are better than others. The reason why you add customers is to diversify your revenue streams. This is a portfolio approach. You want to diversify the types of metal, You want to diversify the customers, and that lowers risk. So I'm talking now about why this platform has lower risk than it had before. And this is the slide that proves that. This is the company as of 1 April. This is the company 3 years before that. That company generated $31 million for the half, about $5 million a month in revenue. Today, actually, that number is 11 million because of the plane we delivered last week. So we've more than doubled the size. And of course, we've more than doubled the customers. So if one of the airlines goes, because airlines do go bust, we all know this. We had Air Berlin a year ago go bust on us. We transferred that plane to EasyJet. And we did it within weeks because we choose the most popular aircraft. And we go in and get our asset if there's ever a problem. So that's why this platform is far less risky than that, and that's why we got credit ratings upgrades from S&P and Fitch. So hopefully that explains why growth opportunity is still intact, and that the investment today is actually less. We can do more things and more airlines than we ever have become. And what's more, we've told you in our RNSs that we've got growth coming right now with those 6 planes delivered in the next couple of months that will grow our fleet, grow our revenues, and grow our earnings. And this is the proof of what I'm saying. This is an 8.5-year history of the company. This is $160 million of planes. This is over $1 billion worth of planes, and you'll see that every sort of 3 years doubles. That's exactly what our strategy is today. I'll finish with this slide. This just summarises what we've got. We're going through one of the greatest growth spurts in the 13-year history of this company with 3 planes last week, and a minimum of 6 to come. We're looking at other stuff right now. So I expect that 6 in the next couple of months to be a minimum. That'll actually take us to almost 50 aircraft by 30 June. That'll be 48, 49 aircraft. The industry, despite you hear of WOW, you hear of Iceland, you hear of airlines going bust all the time. The truth is that the airline industry are carrying more passengers than they ever had in the history of the world, and they're making record profits as an industry. Now, individual airlines in that industry will go bust. To mitigate that risk, you choose the most popular planes, and you go get them if there is a problem, you put them with other airlines. We've had to do that in the past, and we've lost a couple of weeks' rent. We've got a very young fleet, and you see there's $1 billion of revenue attached to that fleet that will pay off the debt that is associated with those aircraft. We're increasing our diversification of airlines and aircraft, which lowers risk. We've evolved the debt capital structure using more unsecured debt, which actually improves the credit rating. And the other thing that we did this year, which is detailed in the 31 December half-year results, is that we sold one of these aircraft. We had 8, we sold 7. This is the aircraft we have the biggest investment in across the fleet. It's a $50 million aircraft. That aircraft in our book, when we sold it in December. The book value was about $48.6 million, I think, from memory. We sold it for over close to $54 million, made a $5 million gain. What that says to you is that our biggest investment, the plane that represents most of our fleet, is the book value is below its realisable value. And right now the shares are trading around the book value. But if we can sell everything for higher than that, surely the shares are undervalued. And that doesn't even take into account the growth that I've just talked about, with the 3 planes last week and the 6 in the next 8 weeks. Those are 2 fundamentally, please value this stock fundamentally. Don't buy it because you like planes. Don't buy it because you like my Australian accent. Buy it because fundamentally this is a good investment, and we've got proof in our history. We actually walk the talk. We double our fleet every 3 years, and that has led to a doubling of the share price. That's all I've got to say. So I'm happy to take questions. I know there'll be a couple of questions about Boeing 737 Maxes, so fire away.
I hear what you're saying about the growth of the market overall, but who are your main competitors? How are they doing, and why do clients choose you?
Right, we're in the top 50 lessors in the world. To be in the top 20, you need about 100 aircraft, so we're on our way there. The biggest in the world that do what we do, one is GE, who owns GCAS. They have 1,400 planes, 40 billion, so they're 40 times larger than us. The other is AirCap, which is listed in the US. Its code is AER, if you want to look it up. And they're about the same size, 40 times larger than us. What those guys do is that they go to Delta and British Airways and the biggest airline, and they try to lease them 40 planes in one go. We're looking for the 1, 2, 3, 4 plane deals. And that's what we successfully won. You know, this is our announcement. We got a contract supply for to Air Baltic. That's a perfect deal for us. And a deal that the guys at GE probably, they were to do 10 brand new $150 million A350s. It's too big, that's too big a deal for us. So they can't be bothered getting out of bed to do the deals we do, and we're not big enough to do the deals they do. So we fit right, well, and we buy planes from them. When they get 10 planes, they actually have to sell down a couple to manage their portfolio risk and concentration. So we bought from the other big lessors. We're actually friends with them.
So why do you think you're undervalued? And then following on to the previous question, how does your smaller deal size impact your pricing numbers?
Well, I told you why we're undervalued. Well, this is a company with a cumulative annual growth rate of 30%, got a PE of 8 or 9,
no,
right?
But
No, you asked me why we're undervalued, I'm telling you.
Yeah.
And I also told you that typically for this industry, lessors are valued like banks at net asset value per share, and that's where we're trading right now. But we've just proven in the last 6 months that the realisable value of that fleet is above that net book value. So that's why we're undervalued. We're given nothing for growth, and we're not, and the market doesn't recognise that if we sold all our fleet today and gave the money out, we'd probably give you back £3.50, and the stock's trading at £2.80. That's not why that helps you sleep well at night. You buy the stock because we're going to double the fleet, double the revenue, double the earnings. That's why.
I get that, but why is the market not taking that into consideration? You're just suggesting that the fundamentals.
Well, the market's not right. Market's not perfect. I mean, what they told you in economics is wrong. You know, the FTSE volume and liquidity year on year is down 30%. You guys know the answer. This is you. That's who you are. And because there's so much negative sentiment about Brexit, there's so much fallout for retail investors because of MiFID II. You aren't getting perfect information, so how can the market be perfect? That's why it's undervalued.
We need to leave it there with that, sir.
I'll just a couple more. Look, I'll take 2 more questions, and I'll be downstairs at the booth if you've got any questions after that. So
Just a quick question. Thomas Cook will put their airline up for sale.
yeah, good news. Look, the likely bidders for that are very large airlines like Lufthansa, which is much better credit rating. If that happens for us, it'd be a credit positive, lower risk. It should send our share price higher. Whether it will or not, I don't know, because the market's not perfect.
You mentioned the 12%
Yeah.
rate. What's the trajectory of this 12% over time?
Well, it actually increases because if you think about a fixed rate of rent, which all our lease contracts are fixed, the planes depreciate every year and so the yield on an asset as it depreciates goes up because your numerator is a fixed rate of rent and your denominator is a declining asset value. So yield actually goes up. So we've got a very high yield at 12%, but these fleets are young. So as that fleet ages, the yield goes up.
But for the new airplanes, so a new airplane today versus last year.
Yeah, well, you might rent a brand new plane for say 10%, but over 10 years that yield increases as the asset depreciates. So I don't want to take up the next speaker's time. So if you've got any other questions, please come downstairs. We're at the top of the stairs. We're pretty easy to find. That's where we were last year. So thanks for your time.